There are bad and ugly things in the investment world. The big guys, the insurance companies, the brokers, the mutual funds, and the pension funds all trade with each other on what are called black pools. And these black pools are not public, and when they end up in the hands of the brokers, they don't keep them. They sell them to their clients. Typically, a brokerage company will take big blocks of stocks at a discount and then sell them through their retail brokers to their clients and try to do what is called pump and dump. That is, they'll buy a stock that's trading at 20, they'll buy it at 18, and then try to pump it up to 22 or 24 when they sell it to the retail clients. As soon as it's all sold, they're no longer interested. The brokers have a big conflict of interest. The brokers are encouraged to do the selling of those things that the brokerage company wants to pump and dump. They sell mutual funds, and mutual funds have several flaws. First, there have been some good studies that their ability to pick stocks is very little better than simply throwing a dart at a page of the Wall Street Journal. And they have a fee, usually more than 1%. And finally, there's an insidious problem with the mutual funds in that their clients tend to buy them high and sell them low. So that when the stock market goes up, people get interested, they start buying at the top, forcing the mutual fund managers to buy when things are high. When stocks go down, the stock market goes down, the price of stocks go down, people tend to abandon ship, and that forces the mutual fund company to liquidate, which makes them sell low. So by not doing such a terrific job of picking with a 1% plus management fee, and with this buy high, sell low clientele, it makes it tough. There's also annuities. Now, annuities are often sold by the free lunch, free dinner crowd. In this case, they have shills, essentially, shilling for each other. And at these groups, the thing they really need to sell you are some version of annuities. Annuities have a 10% upfront loss of principal. And you can tell that by looking at what is the fee they charge if you want your money back. This fee ends up partly going to the person that sells it, partly to the company that issues it. These companies use the money to buy bonds, and then they credit their annuity holders with about 1% less than what they're getting for their bonds. So in short, annuities are illiquid and low yield. The thing that the broker wants to do in selling you annuities is to make that kind of profit. Although the other thing brokers do is churn your portfolio. This churning is from, first of all, pumping and dumping. And secondly, it's from style. There's a style in stocks. Just like there's a style in clothing, there's a style in automobiles, there's a style in stocks. And the big outfits tend to move from one industry to another. They'll be in steel, and then they'll be in oil, and then they'll be in computers, and then they'll be in banks. But at any rate, they move from one to the other. And when they move from one to the other, you don't want to be the last in and the last out. The last in will buy it at the top. The last out gets to sell it at the bottom. And I liken this to a herd of cattle. The cows in the back get the short grass, and they have to watch out where they step. The free lunch crowd is something I kind of dwell on. Some of those are simply Ponzi. I mean, they're going to take your money and go have a good time. But even the ones that aren't Ponzi, they really do a good job of selling. I mean, they'll have several people and they'll each be shills for the other. And some of them are insurance people being shills for the broker who is shill for the lawyer. And they pass people around, but they're really a bad place to put your money. And it's a bad place to pick brokers and lawyers